In today's video, we'll be going through the top 6 mistakes that beginners tend to make when investing on platforms like Vanguard and other providers here in the UK. When you start out as a new investor, understanding the funds and platforms you're using can be confusing and overwhelming. There are a few easy mistakes which you can avoid and we'll go through in today's video. The first one is investing before you're in the right position to do so. The legal age to start investing in a stocks and shares ISA in the UK is 18 years old. There are also junior ISAs which you can invest in from the age of 16. The earlier you can start investing, the better, because you're putting yourself in a position to benefit from time in the market, which will allow your investments to compound over time. Despite this being a good thing, there are some conditions to think about beforehand. Before you begin, you need to make sure that you have no high debt or any financial products where you owe money that you're paying back every single month. Examples of this could include credit card overdrafts, which can get very expensive, and you'd want to get rid of those high interest debts first. In the stock market, you could make 10 to 15% if you're invested in a medium to high risk fund, but if you're paying back debt which has interest higher than that, then it means it's costing you more money and you should aim to pay that off first. You'll be in a much better situation by ensuring you pay off all of those debts before you start investing. So it's about assessing the interest products that you have and working out where your money is best spent. So that could be paying off the high interest debt product, or by putting it into the stock market where you could potentially get upwards of 10% a year. It's also important to remember that you should have some emergency money stashed away in cash that you can easily access if you needed it. Now the going rule of thumb is normally 6 to 12 months, but this does depend where you are in life. If you're in your early 20s and you don't have that many commitments, then you could probably bump that down to 3 months at the absolute minimum, just so that you can afford rent if you lost your job. So you should make sure you have a cash pile available first before you start putting loads of cash into the stock market. Building wealth in the stock market takes a lot of time. You need to have patience and the willingness to invest consistently over the long term. It's definitely not a get rich quick strategy, and it's more the long term play. So it's really important to make sure that you're not setting yourself unrealistic expectations. Index funds can fluctuate and they can go up or down, and you may invest your money and see that it loses 5% in the first week because the markets are volatile and you've invested in a volatile fund. It's not something that you should be afraid of, because you only lock in a loss if you withdraw that money. Right now it's just numbers on the screen, and that money you're investing into the stock market, ideally you shouldn't need to use that money for the next 5 to 10 years at minimum. That will give the stock market time to ride out any potential dips. You could be investing your money this year and there could be a huge crash and we just don't know it yet. But as we've seen in the long run, the S&P 500, which is the top 500 companies in the US, has gone up around about 10% every single year. Some years it's done really well at 20% and some years it's done really bad at 20%. But that's the average trend, which is why you need to look at this from a long-term perspective. Many wealthy people like Warren Buffett aren't as rich as they are because they timed the market or because they selected a certain fund. The reason they're so wealthy is because they spent so much time in the stock market and they've invested from an early age. So they just had the benefit of spending 70 to 80 years in the stock market, which has allowed for a staggering amount of compounded growth. The other extreme is putting your money into an average or a low risk fund, because you might be a little bit scared of losing that money, but expecting this to have massive gains over the years is very unrealistic. A low to medium risk fund might only gain about 1 to 5% a year, so it's important to have your expectations in check. The next one on this list is putting all of your eggs into one basket. The number one key piece of advice you should always remember with investing is not to put all of your cash into one single stock or share. The great thing with Vanguard or other similar platforms out there is that when you're investing into an index fund, you're spreading your money across hundreds of different companies. Now a really good thing to do is to head onto these platforms and search for all the funds and choose one that's based on your risk rating, as well as looking at the portfolios and what companies are inside of them. On the platform you can look at how it's performed over the past few years and think about where you want to put your money. If you want to keep things very simple and easy, a good option could be using the Life Strategy fund that Vanguard offers, as it's a fund filled with multiple index funds and bonds from around the world, giving you a large amount of diversification across all sectors and markets. Spreading your portfolio across different sectors is always a sensible thing to do, because let's say for example you invested all of your money into the US. If that takes a hit, then that affects your whole portfolio. But then if you're well diversified, other markets like the UK or Asia, things may not be as volatile and the whole portfolio stays somewhat stable. And that's what you get when you're investing into the Life Strategy fund, because it's so well diversified and it allows you to invest in the entire world. It offers some protection by diversifying across many companies and sectors. So as one economy has an issue or a potential crash, the other ones are still doing reasonably okay, and that's good for your portfolio overall. The next one is using past performance as an indicator of future performance. Now you might have heard the famous phrase before that past performance isn't an indicator of future performance. The worst thing you could do is go into Vanguard and search for all the funds and look at the highest performing fund, and if you did take a look, it would most likely be the S&P 500 or the American Equity Index Fund, and then just assume it's going to be the same every single year. These are very good funds, but these results aren't guaranteed, which is important to remember when you invest in anything. investing. This year you could put your money into the S&P 500 and it could go down 15 to 20%. It's something that we really can't predict. And if you understand the companies you're investing in, then it makes it a lot easier to invest for the long term because you have the trust and belief that hopefully it will improve over time. Let's say you invest in the S&P 500 because you believe in the companies in that fund. It has a lot of the big American tech companies, and many people believe over the long run these companies will continue to grow because they understand these companies are always innovating and pushing the boundaries. Apple, for example, has a big share in the S&P 500. Not only does it make iPhones every single year, but they're now designing and building their own silicon-based chip, and that's something that's very scalable. It's this kind of innovation that you want to be putting your money into because that's where the profits are likely to be made. And then when this happens, ultimately the performance gains in your index portfolio will also increase. Understanding and believing in these companies is something that you should try to do as it will help you stay the long term. The next one is not using index funds. Now on Vanguard, when you sign up to the platform, you'll see that there's loads of different funds. There's sections for equities, bonds, and blended funds. And the difference between these is that the equities are shares in actual companies through index funds, and an index fund is just a big central fund that invests across hundreds of different companies rather than one individual company. So it is a very sensible and a great way to invest your money. Bonds are essentially government loans. These are seen as lower risk. For that reason, they offer lower returns at the same time, but it's a stable way to invest your money. Don't be afraid to invest your money into some of the higher and medium risk funds. That's where the higher gains are potentially going to be made. If you are a little bit unsure where to invest your money, the Life Strategy Fund offers a mix of bonds and equities. They have a few different funds to select from, so you could go from 20, 40, 60, 80 or 100%. All the numbers mean is that it's just a different weighted allocation, and it determines how much of your money is going to be invested in bonds versus equities. So the more risky the fund is, the more that it will invest in equities because that's more volatile and that could go up or down, whereas bonds are a bit more stable. For example, a 60-40 fund, 60% would be in equities and 40% would be in bonds. So it allows you to have a mixture. Whereas if you were to invest into the 100% equities, it just means all of that money is invested in stocks and shares. And the final one on this list is not keeping an eye on your investments. Now with a savings account, you can just leave your money in there and look at it in a few years time, and you'll see that it wouldn't have grown very much, but you do have peace of mind that it's there and you know it's safe. When it comes to your investments, it is good practice just to keep an eye on it. If you're investing in index funds, this is really easy and simple to do, and you can just consistently invest your money in there and leave it and look at it every couple of months or so, and over the long term you're likely to see an increase. But it is just good practice to keep an eye on it just so you know what's going on. Sometimes you will see a dip, and it's important just to hold your ground and keep your money invested in that particular fund, especially if it's in a strong market invested in really good companies. So you'll be aware if there's a dip in the market versus a huge surge, and you'll have a good idea of what your money could be worth over the long term, and it could help you plan your money going forwards. So now you've learned about the top mistakes beginners can make when investing. If you'd like to learn more about this, you might like to check out some of my other videos listed above. Thank you for watching.